Hi and welcome to Swissquote's Daily Market Talk. It's Friday, April 25th. Signs of easing trade tensions between the US and China, dovish comments from the Fed members, and strong earnings from Alphabet are boosting appetite for equities around the world and supporting a recovery in the US dollar this morning. But risks remain, obviously, and optimism hinges on Donald Trump, whose track record on policy consistency is anything but reassuring. But before we go, please note that opinions that I will be sharing here in this video are my own, and this is not financial advice. So yesterday allowed global risk investors to take a deeper breath. European equities gently extended their gains yesterday above the 50% Fibonacci retracement level on March to April decline, while US equities jumped. They didn't jump necessarily on Donald Trump easing pressure on the Fed chair Jerome Powell, nor on news that US is talking with Beijing about tariffs, because Beijing simply denied the news that they are talking, but that was mostly because a few Federal Reserve members said that the interest rate cuts in the US could be in horizon if Donald Trump's trade policies hurt the US economy. Note, however, that China, despite denying the news that they're talking with the US, said today that it considers easing tariffs on some US imports and a further signs of de-escalating trade tensions between the US and China, and supporting earlier comments from the US President Donald Trump and his administration that the triple-digit tariffs could come substantially down. And that's good news. So as a result, the Chinese CSI 300 index is better bid this Friday, while Hang Seng index in Hong Kong is up by nearly 1.5% at the time I'm talking here. Now again, part of the optimism is due to a possible de-escalation of trade tensions between the US and China, and part is due to Politburo's reiteration of proactive fiscal and supportive monetary stimulus to support the Chinese economy. For the US equities, optimism is mostly due to the Dovish Fed comments, as I said earlier, thanks to a few Federal Reserve members that actually have started to lower their guard. In this context, Christopher Waller, for example, of the Fed, said that he would support rate cuts in the US if jobs get hurt, and Beth Hammack said that the next Fed cut could arrive as early as the June meeting if there is clear evidence that the US economy is plunging due to tariffs. So if Atlanta Fed's GDP now forecast is any indication, well, the US economy could post a 2.5% decline in the first quarter of this year, and that's down from 2.4% printed for the last quarter of last year. And activity on Fed funds futures assesses more than 60% chance today for a June rate cut from the Fed. The problem or the risk with that is inflation outlook for the US is uncertain. So if the economic slowdown due to tariffs can temper inflationary pressures due to tariffs, so rising inflation due to tariffs will limit the Federal Reserve's scope for action. And that's the major risk regarding the dovish Fed expectations right now, and that's the major risk for the US investors as well. For now, though, keep calm, because the market moves hint that investors remain optimistic that the Federal Reserve will step in sooner rather than later and help the US economy navigate the agitated waters. The US 2-year yield, which best captures the Fed expectations, stands below the 3.80% level this morning, compared to around 4.40% at the beginning of this year. But we also get a sense that the companies will actually be trying to pass the tariffs and the tariff-led costs onto their clients, and this is what giants like P&G and Unilever warned this week. Mind you, Unilever beat estimates in the first quarter of this year because they hiked prices, and P&G's CEO actually said very clearly that the company will likely raise prices based on higher tariffs. So now all eyes are on the economic data. Inflation and employment figures will be close to watch from now on to determine what the Fed should do or how much they could do to help easing the pressure from the ugly trade tensions. In Europe, the situation is a bit different though. Falling energy prices since the start of this year and cheaper US dollar makes the inflation outlook for the Eurozone and for Britain much softer than in the US, and softening inflation means that the European Central Bank, so the European Central Bank and the Bank of England could eventually continue to cut their interest rates to give further support to their economies that are poised to slow down due to the rising trade tensions with the US. So the government spending here, especially from the European governments on security and infrastructure due to geopolitical tensions with the US, will likely boost prices in limited areas, it is said, and won't necessarily generate a broad-based price pressure across the Eurozone. As such, the diverging inflation outlook for the US and for Europe, so rising inflationary pressures for the US and not so rising inflationary pressures for Europe, and the idea that the European economies will take a softer hit as a result due to the ECB and Bank of England support the euro against a broadly weakened US dollar right now, though the pair is struggling to find buyers into the 114 mark these days on fear that a too strong euro would also hurt the European economies, as around 60% of the stock 600 sales actually comes from abroad and they melt when converted back to euro when the euro is stronger. For now, the earnings season in Europe is quite mixed. The luxury companies, for example, printed a disappointing first quarter this year, while results of European technology companies was mixed as well, with strong growth from SAP that was announced this week, but significantly lower bookings from ASML that was announced earlier this month. Now, across the channel, the British FTSE 100 index is outperforming the stock 600 peers these days, and that despite falling energy prices that hit the oil giants like BP in the UK. Miners, for example, on the other hand, are performing quite well, especially gold miners. Frenillo, for example, is up by nearly 80%, guys, since the beginning of this year, while Antofagasta is up by more than 30% since its April dip, as copper futures rally despite gloomy global outlook, a rally that is probably explained by a weaker US dollar, Chinese stimulus measures to deal with the trade tensions, supply constraints in the industry, and perhaps also increased buying before tariffs. Now, good news is that the easing trade tensions could further boost appetite in UK's energy and commodity-rich FTSE 100 index. In the US, the sell-off appears to have eased this week, and the first glance at the earnings, at the technology earnings, was not that bad, mind you. Tesla obviously did poorly for political reasons, but Netflix beat estimates, remember, and Google, that just announced its latest results yesterday after the closing bell, showed off a better than expected revenue growth for both advertising and the cloud segments of the company. So investors were happy because the results actually justified the company's AI spending plans, hence giving also AI investors beyond Google a timid smile that the AI theme is not dead. It is just that it is a bit left behind the Trump headlines. As such, Alphabet jumped more than 4.5% in the after hours trading after announcing its results, and will have an opportunity to break free from the year-to-date bearish trend at the open today. If all goes well, today's post-earnings jump in Alphabet could send the share price well above the critical 38.2% Fibonacci retracement on this year's slump into the medium-term bullish consolidation zone, hinting at a possible further recovery in the share price. And the idea that AI helps boost revenue and justify spending should also fuel appetite in AI enablers like Nvidia, for example, by diverting attention from the tariff war, at least for a while. As such, Nasdaq futures are leading gaze this morning at the time I am talking here, and investor sentiment across major markets hint that this week will likely end in a better mood than when it started. So let's now cross fingers that the weekend news don't spoil the latest optimism. So this is all for this week. I'm İpek Özkardeşkaya, and thank you for joining me, and thank you for all your beautiful and supportive comments. I hope This episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below as usual. Follow us on Instagram, on X, on LinkedIn, but also on our WhatsApp channel, Threads, Telegram, and Blue Sky for regular market updates, and subscribe of course to our YouTube channel for daily market comments. And please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again next week, and until then, good day trading and have a lovely weekend.